Today I'm going to talk to you about investment risk and what it means to you and what it means to advisors. Now, as soon as you use the word risk, what does it conjure up in your mind? It conjures up danger, fear, worries, and when it comes to investing in shares, for example, there has been a study that has shown that people who invest in shares, the fear of loss on those shares is akin to the fear of death, which I find quite extraordinary that people could think that way. But anyway, let me show you by means of a simple table what we mean by investment risk and what clients perceive as risk. So time and money. So let me give you a simple example. Let's assume this is a 10-year period, and this might be the pattern of a typical low-risk investment over time. It may go fairly straight line, probably because it's a bank deposit, for example, or national savings certificates. Now, if you are like the average person in the UK, you may have an average attitude to investment risk, in which case your investment is more likely to perform like this. So it will fluctuate up and down like the waves of the sea, and you'd expect it to finish higher. Medium risk. So it fluctuates in value more. Because what we'd all like to have is higher returns, but the highest returns come with more fluctuations in value. But over long periods of time, highly likely to finish higher. So that's the key. If you're going to invest short term, where do you want to invest your money? Probably in the low risk category. But if you're looking for long term returns that are going to really make your money grow, the main thing you're going to be giving up is the steady returns. It will fluctuate more in value, up and down, and that is what we call volatility. Clients perceive risk to be the risk of losing money, but in our book, it's purely the increased volatility. As long as you've got a long-term time horizon of at least 10 years, then it makes more sense to invest in higher risk investments than lower risk investments. Particularly because high risk investments tend to be in shares, in property, and these are what we call real assets. And real assets is where your money can grow, keep pace with, or even beat inflation. Whereas if you're in the low risk investments over long periods of time, typically bank deposits, quite frequently inflation is higher than the interest rate you're earning, which means you're likely to find that the value of your wealth depreciates, doesn't keep pace with the cost of living, and in which case it's a problem.